Guys, thank you so much for joining in. We're actually going to talk about why accounting is important. And you might have heard a lot of gurus in the market speak about financial understanding being the key to understanding and developing a sense of entrepreneurism. And yes, it's true. To become well efficient and equipped as an entrepreneur, it's important to understand the numbers and how finance works. You might have also heard of Robert Kiyosaki saying that financial understanding is key to running a business, and it's because of a lack of that understanding that a lot of people are losing money. And yes, that is true. So today we're going to talk about analyzing and deconstructing the transaction. We're going to see from an accounting perspective, whenever a transaction takes place, when there's a debit and a credit, you'll see what happens from an accounting perspective. So, to jump right in, today's agenda will be to analyze business scenarios and see how it affects the accounting equation. Now, let's actually look at the accounting equation. The accounting equation is let's say, the basics of understanding accounting. And there are three things you have to understand here. So, this is just a quick recap from some of the other lessons. An asset is something that you buy that puts money back into your pocket. It's something that a company invests in order to grow over time, and also an asset can appreciate in value, or maybe the asset that they've purchased. For example, let's say if you buy a piece of property that appreciates over time, that is one form of asset growth. But also, what if the asset is able to bring back money into your pocket every month? Let's say the property that you bought, you rented it out, and the tenant that lives in that property is paying you every month. Now that, in the form of cash flow, makes that particular property an asset. Now, the same thing, let's take a very expensive car, right? So let's say that if you buy a Lamborghini and now you want to turn that Lamborghini into an asset. If you are able to rent out that Lamborghini for special occasions or weddings, or just for a joyride, and as long as you have the right insurance and the right things in it to protect that asset, and if it starts to actually bring back money, so if the Lamborghini is able to be rented out and bring back money, then it will be an asset. But otherwise, if let's say you go and take your life savings and then waste it on a Lamborghini, then of course that's going to be a liability. Plus you're going to have to spend money to keep it running, and maintenance and the regular service and the oil change, and all of that adds up. So anything that takes money out of your pocket is a liability. And to understand owner's equity you'll have to get back into the basics, right? So let's say tomorrow you're starting a business and you invest $10,000 into that business. Now that $10,000, especially with you being the owner, would be your piece of the owner's equity, because you've invested personal assets into the business. So this is the accounting equation. Now let's say you go to the bank, right, and you take a loan from the bank of $10,000. What happens from an accounting perspective? So in the asset column there is $10,000, because that $10,000 that you've borrowed is now used to grow that business. But also, because it's a loan from the bank, it's actually a liability. So in the liability column as well, we put $10,000. All right. Now, thanks to the bank, now we have a cash balance in our asset column of $10,000. Now, with the $10,000, what we do is we go ahead and we take $2,000. So let's say we take $2,000 to go ahead and buy something, buy equipment or fax machine, photocopier, or maybe a new desktop that can help be more productive, or that can help the overall growth of that business. And what it's actually construed as is not an expense, but it's something that can help the business grow. So let's look at what happens to our accounts. Out of the 10,000, we have taken 2,000. So our cash account actually goes below or gets reduced by 2000. So I'm going to take negative expenses in the brackets here. But spending that 2000, we've not lost the money, but we've actually gained the same amount under the equipment column. So 2000 has been subtracted, and in equipment we have gained 2000, which means our balance here, right, I'm just going to note it down here, our balance here is 8000. Now there are many principles of accounting, and one of them, and this is important and we're going to discuss this today, is the revenue recognition principle. Under this, no matter when cash is received, revenues are only recognized when goods and services are sold. Now, let's talk about two other things here. Let's talk about accrued revenue and deferred revenue. Under accrued revenue, it's revenue that's recognized before cash is received and revenue that's recognized when cash is received. But to take a simple example of this concept, let's say you and I were to do business, right? And you ordered a car from me, and I was to tell you that, okay, the car's ready, it's out on the lot, why don't you take your keys and you can drive it right off. If you were to make the payment to me right now and collect the keys, sign the paperwork, take the car away, then that would be, or that would allow me to recognize that revenue. But let's say that you came into the showroom, you took a look at the car and you said, okay, I love this car, but it's not available in the color that I want and in the options that I want. So I'm going to give you a check now for the car, but I want you to custom make that car for me and deliver it 3 months later. And I go ahead and say, yes, we signed the paperwork, and 3 months later, I deliver the car to you. So in this situation, as soon as you give me the check, and of course that check is paid 3 months in advance, I actually have to list it under a liability. Why? Why do I list it under the liability? So let's take a look at this once again. I list it under liability because I'm still yet to give you the car, because I've not actually fulfilled that contract completely. But the moment I deliver the car to you, then I can record that as a revenue, because the goods and services, in this case that's the car, is delivered. Alright, what if the opposite scenario was true? What if the customer came to you and said, hey, why don't you give me the car today, but I will pay you back for it a week later? And of course, if you're the kind of dealer that does that, please give me a call. But you went ahead and you said, yes, I'll give you the car right away. You can come back and you can pay me next week. Do I record that in my books as revenue received? Well, yes, you do. But the only catch is under the customer section, you will say customer is still yet to pay you money. And in accounting terms, we call that accounts receivable, wherein you've already finished giving them the product or service, but the payment is still due. A simple example you can take would be any software company, right? Or any service-based company. Let's say if you have delivered services ahead, let's say you run a company that builds websites for people, and you have built someone a wonderful website, but they've promised that they will pay you at the end of this month. And you can go ahead and record that revenue, but under the accounting section, you will say accounts receivable of X amount of dollars for website services. So the customer comes back a week later and says, hey, I've got your money for you, and he actually pays you for the car. So at this point, do you recognize that revenue? No, because you've already recognized that revenue from a couple of days ago when he actually took the car from the dealership. You don't have to recognize that revenue again, except you had made an entry in your accounts receivable column for the amount of that car. So let's assume that the car costs 10,000, and in this case what just happened is you have received 10,000 in cash, and in your accounts receivable column you can actually negatively mark 10,000 because that money that you were supposed to receive, now you have received. So cash goes up by 10,000 and accounts receivable goes down by 10,000. Right, and guys, this is the concept of revenue recognition. You recognize revenue when the product or service is delivered, not when you actually receive that money. So let's take an example of an insurance company. Let's say you purchase insurance at $500 for 5 months of coverage. Now, can the insurance company recognize that revenue right away? No, because they have taken $500 from you, but they have not provided that coverage yet. So that revenue is recognized every month. So let's say $100 is recognized every month for that coverage provided, because they've only provided all coverage, which is complete 5 months of coverage at the end of those 5 months. So either they choose to recognize it all at once, but they can also recognize it at the end of every month because they have finished providing that coverage to you, and that's revenue recognition. You recognize revenue when the product or service is delivered. Guys, thank you very much for watching this video. If you enjoyed this, please go ahead and subscribe to the channel and also smash that like button. What happens when you do that is it really helps us out with the algorithm and gets this information out to others like you that are struggling to find relevant information on accounting, finance, and entrepreneurship. And the next set of videos you can expect as a part of the accounting series is we're going to get more into the principles of accounting. We're going to understand how transactions are recorded, and we're going to give you that baseline of financial understanding. So whether you're looking to invest in a company, whether you're looking to buy a company, whether you're currently running a business on your own, or you're trying to budget what you require in order to kickstart your next successful venture, this understanding will really help you take things to the next level. So thank you so much. Make sure you subscribe and watch all the videos of the accounting series just to get a better understanding. Thank you. Have a nice day.